welcome back. Markets are in green right now as we speak, recovered about 50-60 points from the day's low. But as we go into the end of this calendar year, let's hear out from Neelkanth Mishra on outlook of 2022. Remember that over the next few days, you'll keep getting a lot of MNC brokers writing about calendar year 2022 and what is their outlook. Here is an exclusive interaction with Neelkanth Mishra.
On the FII outflows, we have to remember that we are in a way in a bad neighborhood, right? So about 35-40% of our FII ownership, it comes from emerging market and Asia funds. And as you can well understand, there's been very weak sentiment on several major emerging markets, starting with China, of course, Turkey, South Africa, Russia, Brazil, and the DXY, the trade-weighted dollar, has gone up 6% in the last 6 months. And that's generally perceived to be very negative for the emerging market. So our currency has broadly held up because of our large balance of payment surplus. But because the FII selling, so if you're selling out of EMs, I mean, there's only so much overweight that you can hold on India. And so, and that selling is generally proportionate, right? So there is some fund being pulled out of an EM fund. So they will sell out whatever has performed well, which is India. And that gives them the liquidity as well. So that's the reason for the FII flows. The question to ask is what happens in the next 6 months? What happens in the next 12 months? And it is very tempting to extrapolate based on what has happened in the last 2 months to say that's going to happen in the next 6-8 months as well. But we need to be a bit cautious there. And the reason is that I have serious concerns on global end demand growth, right? So all this inflation that we are seeing and the supply chain disruptions, the bullwhips that are now unwinding, say like steel, and I think will unwind elsewhere as well. So all of those have confounded or confused signals. I mean, we called it signals through the fog, right? So there's a fog on what really is in demand. Is it strong? Is it weak? Is it moderate? And I think it's weak because outside of the US, retail consumption as well as fixed assets investment are very weak. The sad thing is that we are not likely to see the ability of governments and central banks to stimulate. See, we are used to over the last 10 years that if there is a growth weakness, then you see some kind of a stimulus, right? And that supports markets, that supports the economies. When the whole narrative is around inflation, and rightly so, because it is elevated in many countries, then how do you get policymakers to stimulate growth? And I think that should be our bigger concern. And that's why I do not expect FII flows to be very strong. But at the same time, you can't expect that, so even if the DXY was to go up by 10% from its recent lows, we've already traversed half of that. And to expect that a similar quantum of outflows and that will decimate the market is also unwise.
Sure. Neelkanth, what is your hypothesis for the next 12 months as far as Indian economy is concerned, taking into account the factors, and what do you see the triggers, 12 to 14 months ahead?
Great. So I think that the economy is doing far better than the current narrative. We did see a bit of a blip in November because energy prices had gone up, and that was a huge headwind to the economy because rising oil prices, fertilizer prices, food, the edible oil prices, coal prices, gas prices, all of that had annualized. The headwind was almost $40-45 billion, which is like 1.5% of GDP. And that's why I think that's one of the reasons why November was slightly weaker. But now that has eased, plus now state government capex should restart. The dwelling construction market is looking very healthy. It will not go to full bloom in 6 months, but at least construction activity should start resuming. We think that manufacturing exports, the shift that is happening, there are strong signs that shift will continue. And therefore, the growth in the economy is going to be stronger than currently forecast. We are calling for a 4 percentage point upgrade to current consensus estimates for FY23. We also think that the growth thereafter, so the growth after base normalization, where the debate is whether we are at the 5.5% trajectory or the 7% trajectory. And I think we should be at the 7% trajectory once we have normalized the base as well. So I expect significant upgrades to consensus GDP forecast.
Right. So, Neelkanth, in this kind of a scenario, how do you propose or how are you building your portfolio to capture best part of this economic expansion in the earnings of listed stocks, and also how much of this is already built in your view, in the prices?
That actually is a very good question. That it's fantastic that things are looking a lot rosier than currently forecast, but how much of it is priced in? And I think a lot of it is priced in. So starting September, we started flagging that, look, even if FY23 and 24 EPS was to be upgraded by 10%, and the Nifty did nothing for one whole year, the 1 year forward earnings in October 2022 would still be one standard deviation above the 10-year average. Right? So it was extraordinarily expensive. It has corrected a bit from there, which makes it slightly more attractive. But I don't think it is fully done yet, right? And so from a pure valuation perspective, it's very hard to make a convincing case for substantial returns over the next 1 year. What can happen and perhaps will happen is that FY24, because see, FY24 looks very far now, right? I mean, people are struggling to forecast the next quarter. I mean, who knows anything about FY24? But the fact is that 1 year from now, we will be trading on FY24 earnings. So the direction that FY24 earnings take is the most important one for the market. And I think that there will be upgrades. So I expect the market to be broadly moving around a trend. So there is a lot of flows, domestic flows. In September quarter, a lot of insurance companies sold. So they act as a counterbalancing factor. So FIIs, as we discussed, were net sellers. I think going forward, they should be balanced, maybe marginal net sellers. But domestic flows remain quite robust. So we should be on the PE side broadly where we are, maybe slightly up, slightly down. But earnings should get some marginal upgrades, and that should provide some comfort on the overall Nifty level. But where we see substantial upside is in the domestic cyclicals, meaning that as confidence in growth comes back, and not just for investors, but also for corporates, right? So companies are as scared because, there are people like you and me. They're as scared about what happens in the next 3 months, 6 months, new variants, global down cycle, and how deep is the economic scarring in India. So as that confidence slowly builds up, I think the cyclical sectors will do better. There is a lot of hand-wringing on the fact that financials have underperformed, right? And truly they have underperformed. But that's not because the financials themselves have done badly, right? So all the fundamental changes that were anticipated, that the NPA cycle is over, provision levels will have to start to fall. There'll be some early signs of credit growth revival. All of those things are playing out. The fact has been that the flows have gone into other sectors, which is why the sector underperformed. But it's done reasonably well in absolute terms. And I think in the next 12 months, as the global cyclicals start to weaken a bit, these would be the sectors to position in.